Yeah, thank you. Thank you very much for the invitation. Excited to talk about this piece about the Luna-tic Stablecoin crash. I wrote this up very quickly after the events in May, and then the paper's been sitting on my laptop for a while. So it's good to present it and get feedback and think more about it. I think it's an exciting issue. So looking back, and that's sort of the background, after remaining close to $1, the algorithmic stablecoin Terra UST lost more than 75% of its value in the 2 weeks of May 9th to May 15th. So we made it even just 1 week. And leading to price collapse of the underlying Luna token. I'm going to talk more about that, of more than 99.9%. An increase in the Luna supply by a factor of 19,000 and the range of more than $50 billion. So, you know, that's not trivial. That's an issue I think that's worth writing an economics paper about. How did the system work? And I'm going to, you know, get more deeper into this in the theory. The system worked by allowing traders to convert the Terra UST coin into $1 worth of Luna tokens and vice versa. So if you wanted to you know, get rid of your Terra UST, I mean, you could obviously trade it on exchanges, but the algorithmic stablecoin literally worked this way that, you know, by the time you try to convert your Terra UST on this wallet, you know, the algorithm would look up what's Luna currently trading at, and if it was trading at, I don't know, $100, then for 100 Terra UST you would get 1 Luna token. Then you could take that Luna token out and sell it. And so even though the Luna token was fluctuating in price, you know, that was meant to keep the Terra UST token stable, and it did remarkably well for a long time. And eventually, you know, that stopped working. Sustained outflow burning of these UST coins, I typically just say UST instead of Terra UST, into Luna tokens resulted in massive price decline of Luna and suspension of convertibility. The cryptocurrency market at large was affected, right? You know, it went down overall in price, and there's a calculation variance that says that $600 billion were wiped out, which one can take with a grain of salt. I mean, if you take the Terra-Luna system, and clearly you see 50 billion there, this 600 billion is sort of inferred from market movements. But it's a key figure cited in the White House proposing crypto regulation. So not only, you know, is it a phenomenon worth investigating, but also clearly influence regulation. So I figure it's a good idea to think a bit about, you know, what happened, you know, trying to, you know, get a framework, thinking through these things, because you know, regulators like to rush ahead and draw conclusions, and maybe they're warranted, maybe they're not. So I'm not going to say much about regulation. I'm just going to try to describe what happened. Okay, so here's a picture of the market capitalization of Luna and UST Terra token. You can see, you know, it rose to about 30 billion, you know, up and down here for Luna, and about 20 billion for UST. And then it all collapsed and went down to zero here, right? And so that's the ratio of the 50 billion that I talked about. But it worked quite well for a while. And the reasons worked is, you know, it's not just that this provided stablecoin, but there was this whole ecosystem, how you could trade these things, right? And so you could trade these things on exchanges, of course, but within the Terra-Luna system, you could do this burning and minting of Luna and Terras, right? I mean, sort of, you know, going back and forth between the two, depending on the market price. You could stake Luna to get staking rewards in the Luna blockchain, and I think the same is true for the Terra blockchain. The Terra itself, there was sort of like if you can think about this, like a DeFi bank associated with that, this anchor protocol that had its own token associated with that you can trade, and it was used for staking and governing it there. So you could invest your Terra UST there, and then there might be borrowers borrowing from that. And these borrowers do that in order to really borrow dollars, right? And that's the attractive thing about these stable coins. You can write smart contracts that automatically execute under certain circumstances. Why is it interesting? Because these borrowers often promise a high interest rate. We can talk about a little bit, you know, how they could do that. But they have to constantly, post collateral, if you like, and a smart contract would check whether collateral was sufficient, and if it wasn't sufficient, the position was cleared out, essentially, making this borrowing and lending risk-free. Think about it, that's very interesting and very efficient in some ways. And so how did these borrowers get their interest rates? Well, oftentimes they use that to buy some other stable coins, some other cryptocurrencies, not necessarily stable coins. And they got staking rewards, and these staking rewards can be pretty high, and you can easily earn, they claim, so was it a Ponzi scheme? Was it actually earned? You can debate this at great lengths. But so the appendix goes into more detail there, and there are probably people here that know a lot more about that than I do. I just want to describe this.
Can I ask a question?
Mm-hmm.
So I remember that in the blockchain community, there was a lot of discussion about the Encore protocol because they offer a really high interest rate, and many people, even before the crash, argue that could be a Ponzi scheme or whatever, because it's too good to be true.
Yeah, no, I agree. This is an interesting. I should also say there was a Luna Foundation that kept about 3 billion worth of Bitcoin, in order to possibly march in case there's any danger for the system collapsing, and they did in the end, but the system collapsed anyways. Yeah, you're right. What's sort of weird about this system here, you might imagine that the interest rate is just governed by supply and demand. Borrowers posting certain interest rates, and it's up to you whether you want to invest with them or not. But that's not, so I don't know too much about how that worked, but that's not, my understanding is that that's not how it worked. So the people that had these ANC tokens, they set an interest rate on Anchor protocol. So that's a little bizarre. And I think initially the interest rate was very high. I think set to something like 20% even, right? And you could think, how can that work? Well, it can work in two ways, right? It can work by finding borrowers that are willing to, pay 20% interest, but that's very high, right? The other possibility, of course, is that you just mint Terra UST anyways, right? And that's sort of the Ponzi scheme, and pay for it. And it's sort of can work here because you can always turn them back into Luna and then sell them, but you can see how that could collapse on its own weight. I think it's an interesting issue. I've tried to dig into whether that was happening. I couldn't exactly find out. It's possible, and I think that's a really interesting issue. And but it's also true that eventually the interest rate on the Anchor protocol was lowered actually shortly before the whole thing collapsed. And so some people think that maybe this lowering of interest and made it less interesting to hold Terra UST, and leading to these withdrawals and ultimately the big outflow. So that may have been one of the Achilles heels of the whole thing, right? Lowering the interest rates out of a sudden then becomes unattractive, then it collapses, rather than making this a market. But it's an interesting system. There were all kinds of other, organizations building on top of that, second layers and so forth. It was a whole ecosystem that did a bunch of things. Yeah. Fascinating, I think. Okay, so here's kind of how it went down. So I show you a little movie, if you like. So here's the Luna price. It traded as high as 100, but here it was trading at 60. It come down slightly, but nothing unusual, right? And so it was sort of fluctuating. Here you see the UST price very stable, around 1. I divided the Luna price by 60, not because I think this is a trigger price here or anything, but just to make the plots look nice. And down here you see the amount of UST burned. In fact, some of the numbers were negative. I cut them off because there were people still trying to get UST tokens in some of these phases. Okay, and then, here was a little burning, a little bit more, but not unusual, right? If you look at this blip compared to what was before, was that unusual? Maybe not. But there was, you could see that the UST price starts to deviate from its peak. And then a little later, there was more burning. But even here, you could argue that the burning, if you compare that across the historical record, I think was not unusual at all. But the UST price went away from its peg, so this arbitrage from burning and minting tokens didn't quite work. People were happy to just sell them directly on the exchanges at a price below 1 appears. And the Luna price started going down rapidly. And you go a little later, now it has gone down. Here it has gone down to almost, practically half, right? So now Luna is only trading at $30 or less compared to when it was at $60 over here. So the first thing that I want to observe is that the Luna price collapsed rather quickly to about half of its original price. And of course here the peg was lost, right? And people really started burning. And it kind of stabilized for a little while, right? I think maybe that's where the Luna Foundation came in and tried to buy some of these things, but they burned through their funds pretty quickly. Then they also opened the floodgates so that you could burn more UST tokens. I think there was maybe that this was limited. So there's sort of details of the frictions that I can't get into. Anyways, then eventually, when you see this, you see the Luna price collapsing further here and eventually collapse even more. And now the burning really starts, in earnest, right? So it goes very high up. And the Luna price collapses, down to zero. The burning actually comes down here some, and you're seeing the UST price still trading at about 60 cents and 40 cents. At the very end, traded about 20 cents when it was all said and done. But it's not like the UST price collapsed right away. And that's, of course, because you could still do the burning. You could still do the arbitrage here for a long time. And then it was suspended. So there's sort of an aftermath here that I don't show on this picture. It was suspended, and the suspension of trading was lifted, and the suspension of convertibility was lifted, and was going back, and then eventually was salted on entirely. So there's another picture that has that, but not here. Okay, so the first thing that I want to understand now is actually this burning relative to the Luna price. So this Terra underpricing, the UST underpricing, the black line, that comes in the second part. And I first want to understand this relationship between the burn and the Luna price. Okay, so that's a picture here. That's a Luna price. That's a UST burned. And again, you see this, fairly substantial collapse, but not all the way to zero early on. When trouble was small relative to what came later, right? So I would argue that in some ways the bulk of the burning came much later than this initial half price collapse. Okay, so I want to understand these events qualitatively and quantitatively, simply because I think it's good to understand these events. That's it. I mean, there's no sort of deep policy conclusions. I mean, draw your own. Okay, so I'm going to write down a theory for Luna. And I want a theory that generates a gradual unfolding of the Luna crash, given the rate of UST burning. If you look back at this, it's actually a little puzzling, right? Why didn't this collapse all the way to zero right away, right? When people knew this was sort of an ongoing bank run, right? I mean, why would you still buy this? I mean, there were people buying that stuff still at $30 here, even though there was sort of a rush at the exit door. And you also have to talk about, why didn't everybody try to burn here, right? So that comes in the second step. So why this gradual unfolding of the crash? And people say, well, maybe it was salience, but that doesn't quite explain it because these people were trading it, right? I mean, these are active traders looking at the situation and thinking about it. And I think Nir mentioned that some traders hoped it would come back, and that will be a crucial element in theory. Okay, so I get a closed form solution, I benchmark my case, I get some differential equations that kind of look nice, and I can compare that qualitatively to the data. I think it looks nice. Then I also have a theory for UST, theory that justifies the rate of UST burning and derive bounds for this UST underpricing below $1. And then I use the theory to back out the theory variables from the data. And so I construct, if you like, a time series for these my theory variables to exactly justify the observations. I like to call that the method of quantitative interpretation. I'm not saying other people haven't done this before, but I think it deserves a name. Sort of different from identification or estimation or calibration, right? It's just taking the data and then looking at it through the lens of theory and saying, okay, what are the objects in the theory that would generate what we see in the data? Okay, so let me take you through this. But first, I have another intro slide that I think is very important, right? So people said, oh, this had to crash. Well, not so clear, right? I mean, first of all, how do you price even Luna? Well, the net present value is zero. So if you approach it from an asset pricing perspective, you're stuck right away. But if you're a monetary economist, you say, well, that's no different from other fiat currencies. So what do we know about fiat currencies? Well, benchmark here would be competing fiat currencies, right? So you can think of Luna versus US dollar, let's say. And the classic result is Carrick and Wallace. They construct OLG models. There's no uncertainty there, and so forth. But they have two perfectly substituted money, and then the exchange rate is constant forever. But in particular, it's indeterminate. Could be something high, could be something low, but will be constant. And then Manuel Peck, and then myself in the paper with Linda Schilling, I'd like to point, they had the stochastic generalization, but I like this formulation better. That's in my paper with Linda, where sort of this result becomes a basically martingale result, right? There's a risk factor here, and you just find that QT, so MT plus 1 is just pricing kernel, and you find that the current price of the cryptocurrency should just essentially be the expected future price of the price, modulo some risk adjustment, but why that risk adjustment should happen here. So just think of QT as being a martingale. I think that's what theory delivers. Okay, so if you start with that theory, then all of this should have worked. Let's say price of QT is a martingale, and just for benchmark assumption, imagine that the surprise movements in the price of Luna are uncorrelated with the surprise regarding the Terra UST inflows and outflows. Let's talk about that in a moment, but let's just start there. Well, then, as you burn these Terra UST, take Carrick and Wallace, right? QT would be constant, and you would just create more of this Luna, right? It would just been absorbed by a higher market cap of Luna rather than price collapse. So the first thing I want to get across, it's not that obvious, right? That's sort of different from sort of these bank run models, maybe these currency price models. It's not that obvious that it needed to collapse, and so benchmark theory would say it shouldn't have, right? Now you could fix this by assuming some correlation of the needed kind, but why should there be there? So it's a free parameter. So I go a different route. I impose some assumption for the evolution of the market capitalization of the total value of the outlying outstanding Luna stocks. So M is the total number of tokens, Q is their price in US dollars, and then MT is the market cap in US dollars. And so then, but then I have a tension really with these benchmark indeterminacy results, right? Because now, if I know the market cap and I know the quantity, I can calculate QT. You see, so that's so I should say right away, this assumption here is a little problematic, and when but I think it's a good starting point, and it gives me good theory, but it's not, why is that a good assumption? I think it's something one can think about. Okay. And then we want to know why the crash unfolded gradually. So we need to do this. Let me first show you a simple model that gets me this market cap idea in there, but doesn't get me the gradual unfolding. So that will be in the dynamic version. So imagine there are just two periods, before burning and after burning. There's an initial stock of Luna tokens, let's call that M. And there's going to be a price Q in both periods. Well, the rational traders in before burning, it's martingale, right? So it's the same price has to be in both periods. So when the burning starts, right, when all this starts, then the rational traders say, oops, there's something coming. And, I don't want to be surprised, but, there's no reason to buy it if I know it's falling, and the other way around. So same price. Okay. So then we have a certain burning of BUSD, right? So they're in US dollars. And from that, we can calculate the final stock of Luna tokens, right? So for each B, you get B over Q Luna tokens, right? So if Q is very small, that means you get a lot of Luna tokens. And that means the money stock increases to M tilde after burning. You can rewrite this by multiplying through with Q. And now it's written in dollar terms, right? Because on the left-hand side, you have the after burning market cap. On the right-hand side, you have the before burning market cap plus the USD inflow. Okay, so you see that thinking about market cap is very useful. Let's just make assumption that you happen to know M tilde for some reason, and then you can solve for Q, right? So here's this formula for Q, and I think that's attractive. It also shows you here, right, that you need M tilde to be larger than B for Q to be still positive, right? So I think the simple logic indicates how far you can go potentially with these stable coins. The flaw in this logic is, of course, that the market cap of Luna at the end was much smaller. It wasn't 20 billion what we got for UST. So, and what was even smaller than the amount that was burned. So we need something else to get that. But that's that's sort of one of the key elements here. Okay, so now let me do the dynamics. And imagine there's some date 0 where there is some MIT shock, big surprise, burning BT begins, total surprise to people, but now they see, oh my God, and I'm going to make the essentially deterministic from there onwards. I'm just going to treat as exogenous for this part. But there's a little wrinkle to this. It's not entirely deterministic, as we're going to see. So in the time interval delta now, they're going to burn BT times delta UST coins into BT over times delta over QT Luna tokens, just as in the algebra before, right? So that's in this little time interval. But here's a little bit of stochasticity, and that's sort of in line with Nir's comment, before we start the seminar. Traders still think that there is some probability lambda T times delta that this whole nightmare stops and the burning of UST stops and Luna goes back to normal. And then you get some normal market cap back, right? And we have to make assumptions of what that might be for the theory. So let me call this NT plus delta. But then with probably 1 minus lambda T times delta, the burning continues, right? And so it's this constant hope that gets me this slow unfolding here. And then I assume that if the Luna price reaches epsilon bigger than 0, then you have suspension of convertibility. And at that point, the whole thing is over. And there's going to be some other market cap. Maybe it's different. Could be the same thing as NT, but it could be different. So I call this M capital T. And I just, impose these market caps exogenously, as I did in the previous calculation. So there are these rational traders that they price Luna tokens, take the illusion account, and I'm going to show you I get a system of ODEs and closed form solutions.
Can I ask a question just to see that I'm on the same page? So after observing the burning event, you kind of have, with some probability, you can have a belief that everything goes back to normal, and with some probability, you have the belief that it's going to
right at every instant in time, right? So
yeah, okay.
Take an hour, right? During this hour, that's probably that after that hour it goes back to normal, and then it continues. So repeat that for every hour essentially. And so here's a picture, right? I mean, that's sort of similar to the two-period model that I showed, right? You start with this MT and this price QT, and at T plus delta, you get MT plus delta and QT plus delta. So if there was no exit here, then QT plus delta would have to be the same as QT. That's the same as in this previous model. But here now there is this probability that you exit and the market cap will be some NT plus delta. So probably 1 minus lambda times delta, and the burning will continue. Okay. So there's this exogenous burning coming in. So you actually burn BT times delta because BT is the rate, right? And so the additional Luna coins are coming in as BT times delta divided by the market price QT, and that's how this evolves. And so you can take that picture and then write down the equations, and here they are. You get a forward evolution of the tokens, right? Because if you know the current money stock and you know the current price, then you throw in how many coins you burned, and that gives you how many Luna tokens you have after delta. You also get a pricing equation. The pricing equation goes backward in time, right? Because rational prices say, oh, with probably lambda T, we exit, and then we get some market cap. From 1 minus lambda, we don't exit, and then we get the ongoing price, and so you're going backwards. And so first, when I looked at this, I thought that looks horrible to solve. But it turns out that when you actually look at the market cap, right, that's an evolution that's just backwards in time, right? And so if you know the final market cap, you can just solve it going backwards. And so it becomes much simpler. Okay. So you can write down, so these are the two equations on the top are the same discrete time equation that I showed before. The change in the market cap here is this change here in the, it's sort of lambda T times the difference between the normal market cap upon exit and the market cap that you get without exit. Okay, so that's in some sense what you would be hoping for to get if there's exit. But if you don't get exit, then the MT plus 1 disappears. So this is kind of like return, if you like. And here's the burning. And you can also write it in terms of this YT that I wrote here. I'm going to come back to that, right? You can YT is lambda T times this normal market cap divided by MT plus 1 minus 1. So then there's a YT showing up here. That's another way of stating that equation. And likewise, the price for the price itself, you can, that's, so these are the same equation that before. Okay, so you drive delta to 0, then you get a system of differential equation. And this is a linear differential equation MT. Given the solution for MT, this is a linear differential equation for QT. And then from both, you can solve for MT. Okay. So I'm going to define a relative burn rate, which is BT divided by this kind of probabilistic normalized market cap, sort of easy to write down the solution this way. But we can just use theories of ordinary linear differential equations now to write down the solution. And I have this whole proposition here that states that, but it's just nothing new. What's perhaps a little bit more surprising, even though these are, you'd have to kind of integrate the MT solution to get to the QT solution. So it gets ugly very quickly if you write it out, you're getting these integrals. But it turns out that if you make the following assumption, that the burning is 0 before some date T star. So at date 0, they all realize this is going to happen, but maybe the burning starts a little later, as we have seen in the graph, right? The major burning really started only later. So I want to have that possibly. And I'm going to make burning constant, right? Just to keep simple. So once it starts, it's going to be constant, and assuming that the market exit cap is constant and this exit probability is constant. So making all these things constant. And I have some final market cap MT. So there, I just really have some parameters here: T star, N, lambda, and capital MT. And then it turns out I can write down a closed form solution. Here it is, and one can sort of think about it more. And one can think about how long the whole thing takes. I don't want to bore you with all the algebra. I just want to show you some pictures. And I want to first go through the case where the burning starts instantaneously. So the MIT shock hits, and you immediately go to the high burning. But let's just assume that the market cap upon exiting for Luna is just the normal market cap that you would have gotten also if there was an exit earlier. Then we postpone the initial burning to period 50. So think of 50 as hours, so that's about 2 days. And then finally, we set the final market cap if it's, if this run comes to an end, we set it to N divided by 10. So we're saying that, if the system gets suspended, now Luna is no longer worth as much as a market cap as it would have been if the burning had stopped earlier. And I think that's, that sort of that reasonably captures what I think was probably going through the minds of the traders. Okay. So here's this first. Okay.
Can I ask a question? Can you give an intuition how I can think the difference between option 1 and option 2? It's one way I can think about it is that there is more reputation of time that everything goes well, and only the event starts like later at T50. Like what is
yeah, what's the justification? Yeah, I mean, I think the best way to justify this is by these plots here, right? So here, right? So here I argue, okay, sort of almost hard to say. Here the price already fell by half, but there was just, I mean, okay, there was some burning, right? I mean, it's not 0, right? But the bulk of the burning really only happened later, right? And sort of it's, but rational traders anticipate that. They say, we see something is going on in this market, right? I'm not going to make it even 0, but that's just because everybody knows it's going to jump, right? Here, maybe the fact that the burning started was a canary in the coal mine here, right? That something was up, right? And then because something is up, you're saying, oh, this could get much worse, and therefore I'm not willing to pay for Luna quite as much. The interesting, but it didn't all go all the way down to 0 because there was still this hope that you would exit to normal times, right? And so that's the tension that I want to kind of get at. Okay, so okay. So then you're getting these pictures here. So if you do T star, if the burning starts right away at the state, when everybody realizes that something is up, and if the market cap it's the same as normal, well, then the market cap is going to end up being the same market cap as you had in the beginning, right? And so that's going to be the assumption. It's going through this U-shaped pattern, But that's just because the price dynamics has to take into account this dilution, right? You're seeing this pricing, it has to falls very dramatically and then falls even more quickly, right? So this is a bit too dramatic, and particularly we certainly didn't see the Luna market cap recover like that, right? Okay, so now let's postpone the burning to 50 hours, right? Now you're seeing more gradual price dynamics, almost S-shaped here, right? But the market cap still has this funky U-shaped here. It falls first and then recovers, and because people, as you get closer and closer to the end, right? There's not much dilution anymore, and you just return to the market cap. So finally, if you say the market cap at the end, if you have suspension of convertibility, then the market cap is small. Then we kind of see this picture here, and these are closed form solutions. And you can compare that to what actually happened. So that's these are the data counterparts, and they can sort of flip back and forth and would say, yeah, it's not too bad, right? You're seeing this S-shaped pattern in the price. You're seeing this S-shaped pattern in the price here. You're seeing this burning kind of being low first, high later. I mean, that's it's obviously not zero and then constant, but it's sort of roughly in line with that. You're seeing this funky double hump market cap, and you're seeing this here, which I find interesting. And even for the log price dynamics, it's not doing so badly, right? So this model that we now can solve in closed form generates that pretty nicely. But later on, we're going to back out my theory variables. We're not to exactly get that dynamics and try to draw some conclusions. Okay, so now I want to turn to so this probably to collapse. Let me skip this. Now I want to turn to the UST tokens. And this picture actually extends a little bit beyond the dates that I've shown before. This was the first suspension and then reinstatement of the blockchain. Then this is the final suspension. And there were these 2 dates. Here you're seeing the UST price, and it's sort of bouncing up and down, eventually settling near 20 cents. Interestingly enough, it's now trading at 4 or 5 cents or so. And here seeing the total UST still available, right? And if you look at that, 60% was still out there, not having been burned, right? So I'm going to try to understand the behavior of these people. And in some ways, that also explains the behavior of these people. These people must have been very resilient, thinking that, maybe there's some hope, or maybe the money was tied up in contracts. It's kind of hard to understand. So why did not everybody burn, right? 60% still being out there, having lost a lot of money, obviously. Okay, so what I'm assuming here is that investors have some convenience yield, 1 plus phi I when it's stable and nu I when it's suspended t. And that depends on the investor, right? If you're a very aggressive investor looking at these returns on the Anchor protocol, maybe the phi I is high for you. If you just want to hold the crypto US stablecoin, maybe that's low. And also what you can do with that after suspension may be different across different people. So let's say there's a population distribution for this. And then you do calculation at any point in time. You're saying, should I burn my UST? Well, that depends on how likely it is that the end is near and that you're getting nu I rather than your phi I. And so you're getting essentially population distribution over these threshold probabilities. If the threshold probabilities of suspension is too high, right, it crosses some threshold, then there's an individual burn, but there's a population distribution over these threshold probabilities. And those I try to figure out. Okay. So we could start with this F and then characterize Luna price dynamics. That's hard. It's easier to start with the dynamics and figure out the implied F. So I'm gonna show that to you. And also it gives you an underpricing floor, because the 1 minus P will then be the lower floor for the probability for the suspension. Probably for the suspension is the floor for UST, because maybe you're getting 0. You actually got 20 cents at the end, but the worst case scenario would be that you get 0 at the end. But if you return, then you're getting 1, right? And so the expected value if you trade on an exchange would be P. So this probability, the suspension probability, also gives us a sense for how far the underpricing goes. Why the underpricing was there requires more, because we would have to think about all the glitches in the system, why this didn't work as well as it should have. Okay, so in terms of our model, this was a fraction burned, right? I mean, it's linear, right? Because we have a constant rate after 50. And this is the suspension probability that we got from our Luna calculations. And that means that's a non-suspension. Yeah, that's a non-suspension probability. Sorry, the non-suspension probability. That gives you the floor price. I think I misstated this here. Okay, so this here is a floor price. And then from there, you can calculate this distribution for these threshold probabilities, right? I mean, you want to understand why people did the red thing, given the blue thing probabilities. Why did these people here burn when that probably was already, getting higher and higher, or these red people here burn when the probability was very high. So you get the distribution over the probabilities across the population, and that's this here, right? And so that's just from the theory, right? So okay. So now we can go to the data, and we collected this data, and we wanted to back out the NT, lambda T, and MT there. And we hand collected price data, hour by hour, from going to coin market cap, and I had an RA where I had to hover with the mouse over each data point, write it down by hand in Excel sheet. But I've done this partly myself, so I'm pretty confident the data is correct. But source of errors, right? I mean, if you buy the data, it was too expensive, so I decided let's just do it that way, right? Using labor rather than computers. Okay, interesting. Anyways, so if you do the accounting, how the money stock evolves, it just evolves by looking at the price you're getting for your tokens. It's not exactly QT, so I call it QTA because maybe the average over the time period and so forth. Later on, I'm going to ignore this thing. I'm going to show a picture that maybe justifies this. So you can also look at this change of the price during this period. That's this XT, and just mechanically, just by accounting, you get that the change in market cap will be this, and that the change in market price will be this. I mean, I don't want to go through all the math, but just assure you that these two equations where you have this XT, which you can measure directly from the change in the market price, gives you this change in the market cap and gives you the change in the market price. Well, that you can construct the change in the market price from the change in the market price should be kind of obvious, right? I mean, so this equation is a tautology, right? I mean, it's just rewriting the definition for XT. And the first equation maybe takes a bit more. Okay. Now you can compare that to the theory that we wrote down. And remember, I wrote this down also with this YT, right? And so what the theory gives us, so YT is now defined in terms of this exit market cap, and also in terms of this exit probability, lambda T. And so what you can see is that from the observed market cap and from the observed price, and you really don't get more from the data. You're getting XT here, getting XT here. You're looking at these two equations. You're getting YT here, getting YT here. You don't get independent observations on NT and lambda T. So you have to make, even when you go back to the theory, you have to make an assumption about, say, NT and back out lambda T, or fix lambda T and back out NT. But whatever you decide, whenever you get, if you back out lambda T in such a way, or NT and lambda T in such a way that you get the results in YT, and you said YT equal to XT, you have explained the data perfectly. And that's what I mean by quantitative interpretation. On this QT versus QTA, I have this plot here trying to convince you that the difference may not be all that large. It's not such a great plot, but let me just skip that in the interest of time. Okay. So I have two scenarios here. I have many more in the appendix of the paper. One is assuming that the exit market cap is constant. The other one is that the probability of exiting is constant. I like the scenario A here a little bit more, because that seems more reasonable, perhaps. I mean, you could also make some other assumptions. And you can see that in some ways, traders were very hopeful that this would still all work out, but then eventually they kind of lost hope, right? And because that's the probability, of this thing, still working out, right? In the market cap picture, you don't see it quite as much, and the market cap actually goes, beyond the market cap that was before the crash here for some of these things, but maybe not an average, and we could maybe smooth this. So there are these two scenarios, and then with these two scenarios, we can calculate the price floor, right? Because we get a suspension probability, we can get a price floor for the UST coins, and here it is. So the blue line is the actual price, and then scenario A gives me this red line. You can see it actually is really below this UST market price, so it kind of works nicely. the scenario B, occasionally cuts through the price. I mean, for a simple theory like that, maybe I'm not too concerned about this. And you can have some other theories that maybe compromise on this. So you could try to use this market price to be informative about where you want to be in terms of scenario A and B. Okay. So remember this picture and remember our distribution for P. We can also do this using the data. And then that's the distribution that you get for the probability distribution when agents want to exit, depending on whether you're in scenario A or scenario B, right? So remember, scenario A, we kept the exit market cap constant. In scenario B, we kept the exit market probability constant at some level. Scenario A, I think we kept the exit market cap constant at the previous level. And here with the probabilities, we experiment a little bit of what seemed to generate nice pictures in the appendix. We show a bit of that experimentation. Okay, so this is a probability distribution across these population distribution, and I want to maybe focus on scenario A here. So P50.5 says at that point, the chances that you get suspension and that UST is no longer convertible is 50% or higher, right? And so out of the people that actually burned, what's the fraction of the population that waited until it was 50% or higher to actually burn? It turns out it's still less than 20%. So these UST holders, I mean, you could say maybe it wasn't on their minds or something. They really waited for a long time, right? And so that's very different from this theory picture here, where it looks like most of the people came in early, right? And there are only a few holdouts over here with the high probabilities. Here it's for the high probabilities. People only come in. But that was salience, or people not watching this, or people not being able to do it. I mean, who knows? But I think that's sort of one of the interesting, pictures that comes from this analysis. Okay, let me conclude. So I was fascinated with Terra-Luna crash, and I just wanted to, have a framework to just think that through without any, deep conclusions here. And you run into these challenges. One challenge is Carrick-Wallace. Why a crash in the first place, right? I mean, if the Luna price was just constant, this should have worked. And then also, why was it crash gradual then immediate? And so the way to solve this here, I'm imposing assumption of market capitalization. So that's a tension here to this Carrick-Wallace driven literature. And to get it gradual, I'm imposing the trader's hope for resurrection. But when the price hits floor epsilon, that's it, game over. Okay. And then I get these ODEs that can be solved. I get these nice closed form solution special cases. The stylized version looks kind of nice already versus the data. But we can go all the way into a quantitative interpretation. We can use the data to back out the theory variables. And there's a degree of freedom, as I've showed you, right? You can either back out the lambda t or the n t or some combination. And then can examine the theory variables to understand the crash. In particular, what I found particularly interesting here is the threshold probability of collapse and burning UST was above 50% for more of 80% of the UST holders that actually burned it, before the whole thing was over, right? So so the fraction of people that burned it when the probability was below 50%, because only 40% burned, right? Only 40% burned. Of the 40%, only 20% burned when that probability was below 50%. So it's less than 10% of the people burned it before the probability exceeded 50% of a suspension. I mean, they were really hanging on to this, hoping for the best, I suppose. Okay, so that's it.